Welcome to the True Moneymakers channel. Today's awesome video is titled Mastering Stock Market Basics, Key Terms Every New Investor Should Know. Let's take a look and uncover true money making. Welcome. Have you ever felt overwhelmed by financial jargon in the stock market? You're not alone. Today, we are diving into the 10 essential stock market terms every beginner should know. We aim to help you build a solid foundation in stock market terminology, enabling you to navigate your investment journey with confidence. Let's explore these concepts together and empower you to make informed financial decisions. 1. Bull market. A bull market is a term used when stock prices are on the rise. Picture the powerful thrust of a bull's horns moving upward. This symbolizes a market where optimism prevails. Typically, a bull market might last from several months to multiple years, with the average duration being 3 to 4 years. While there are inevitable ups and downs, the overall trend is upwards, with the average increase in stock values reaching around 110%. Investors find great joy in experiencing their account values soar during these prosperous times, often linked to a thriving economy and initiatives like quantitative easing. 2. Bear market. Conversely, a bear market signifies a downturn, where stock prices decline over a sustained period, typically defined as a fall of 20% or more from recent highs. Imagine the fierce swipe of a bear's paw pushing down. This imagery reflects investor fear and pessimism. Bear markets can last for months or even years, fostering an environment of increased caution. Understanding this term can help you remain calm during downturns, reminding you that while markets fluctuate, they are cyclical. Embracing a long-term perspective can allow you to seek opportunities even amidst adversity. By recognizing this essential term, you can approach bear markets with strategic planning rather than panic, ultimately fortifying your journey as an investor. Understanding quantitative easing, a catalyst for economic growth. Quantitative easing, QE, is a significant monetary policy tool wielded by the Federal Reserve to stimulate economic activity, particularly during periods of economic downturn or recession. By essentially printing money, the Fed injects liquidity into the economy, making it easier for businesses and consumers to access funds. This increase in money supply leads to lower interest rates, which encourages borrowing and spending. As the flow of capital rises, inflation may ensue, resulting in higher prices across various sectors, including housing and commodities. One of the most notable effects of QE is its impact on the stock market. As more money circulates in the economy, investors often move their capital into equities, driving up stock prices. This presents a unique opportunity for savvy investors looking to benefit from rising market trends. The overall aim of QE is to foster a positive economic environment, encouraging growth, job creation, and increased consumer spending, ultimately empowering individuals and communities toward a brighter financial future. Understanding bear markets, navigating through the storm. Conversely, a bear market indicates a downturn, defined as a market decline of at least 20% from its peak. Much like a bear swiping its claws downwards, the sentiment during these periods is often somber. Typically lasting about 9 months, bear markets see stock prices declining by an average of approximately 36%. This challenging environment can cause many investors to feel disheartened and cautious, leading some to question their investment strategies and financial future. However, it's essential to remember that bear markets are a natural part of the economic cycle. Historically, they have often been followed by periods of recovery and growth. Investors who maintain a long-term perspective may find that patience and resilience can yield significant rewards when the market rebounds. Educating oneself about market dynamics and employing sound investment strategies during these trying times can transform fear into opportunity. By staying informed and focused, investors can emerge stronger and more prepared for future market cycles, embracing the potential for renewal and rejuvenation. Understanding the strategy of shorting. Shorting is an intriguing investment strategy that empowers savvy investors to capitalize on declining stock prices. Unlike the traditional buy low, sell high mantra most investors adhere to, shorting flips this approach on its head. Essentially, when engaging in short selling, an investor borrows shares of a stock they do not own, sells these shares at the current market price, and subsequently aims to repurchase them at a lower price to return to the lender. This tactic hinges on the investor's ability to pinpoint companies that are grappling with substantial difficulties, which could range from poor management decisions to crippling levels of debt. As the market reacts to these challenges, a negative sentiment may lead the stock's price to fall, thereby creating an opportunity for the short seller. Thus, the more precarious the company's outlook, the more enticing the potential gains may be for those willing to take on the calculated risk inherent in shorting. It's an audacious strategy that, when employed wisely, can lead to significant financial rewards. Understanding quantitative tightening and its impact. Quantitative tightening, QT, is a monetary policy tool utilised by central banks, particularly the Federal Reserve, to help regulate the economy's growth by pulling back on the amount of money circulating in the financial system. Unlike quantitative easing, QE, where the central bank injects funds to stimulate economic activity, QT seeks to reduce liquidity by selling off assets or allowing bonds to mature without reinvesting the proceeds. This contraction of money supply is intended to counter inflationary pressures that can arise during periods of rapid economic growth. As a consequence, QT often leads to a decrease in stock prices, which can create challenges for investors. By deeply understanding this relationship, investors can better strategize their portfolios, considering when to strengthen or mitigate exposure to stock markets. Awareness of quantitative tightening's effects can empower investors to make informed decisions, potentially safeguarding their investments and paving the way for more resilient financial outcomes in an unpredictable economic landscape. Understanding the dead cat bounce, a cautionary tale for investors. The term dead cat bounce encapsulates a phenomenon in financial markets where stock prices experience a temporary rise after a significant decline. Although this brief upturn can create an illusion of recovery, it is often misleading, as it may simply reflect a momentary correction rather than a genuine reversal in trend. The metaphor pulls from the idea that even a lifeless cat could bounce if dropped from a substantial height, highlighting the unpredictability of market behavior. For novice investors, these fleeting rebounds can be particularly deceptive, instilling a false sense of security that may lead them to make hasty decisions. It is essential to approach such scenarios with a discerning eye, understanding that the underlying trends may not have changed. By recognizing the characteristics of the dead cat bounce, investors can better position themselves to avoid rash choices that could jeopardize their financial well-being. Ultimately, a clear understanding of market fluctuations is vital for making informed, strategic investment decisions that promote long-term success. Understanding the Federal Reserve's impact on the stock market. In the ever-evolving landscape of investing, it is essential for investors to grasp the profound influence of the Federal Reserve's monetary policy on stock market trends. The Fed's decisive actions, whether it's lowering interest rates or implementing quantitative easing, can significantly sway investor sentiment and market direction. When the Federal Reserve injects liquidity into the economy, encouraging lending and spending, the stock market often reacts positively, as seen during the pandemic in 2020. Despite an uncertain economic climate characterized by lockdowns and reduced consumer activity, the Fed's robust stimulus measures led to an impressive 18% surge in stock prices. This phenomenon illustrates that the market does not always respond directly to traditional economic indicators. Rather, it is often driven by shifts in the Fed's policies. Therefore, investors are encouraged to stay informed about the Fed's decisions, as their initiatives can create opportunities or risks that shape the market landscape in ways that transcend general economic conditions. The power of dollar cost averaging. Dollar cost averaging, DCA, is a wise investment strategy designed to minimize risks associated with market volatility. By committing to invest a specific amount of money at regular intervals, investors buy more shares when prices are low and fewer when prices are high. This disciplined approach not only smooths out the effects of market fluctuations, but also reduces the impact of market timing, a common pitfall for many. One of the most significant advantages of DCA is its ability to instill a sense of consistency and patience in investors. This method encourages them to remain committed to their financial goals, irrespective of market conditions, fostering emotional resilience. Additionally, DCA can help build a habit of saving and investing over time, making it more accessible for those who may feel overwhelmed by the prospect of investing a large sum all at once. Ultimately, dollar cost averaging empowers investors by creating a straightforward, strategic pathway to wealth accumulation, ensuring that they remain engaged in their financial journey with hope and determination. Understanding tax loss harvesting, a smart strategy for investors. Tax loss harvesting is a valuable investment strategy that allows investors to effectively manage their tax liabilities by selling off assets that have depreciated in value. Imagine you've experienced impressive gains in your investments over the course of the year. This is something to celebrate. However, if you also hold stocks or bonds that have not performed well, you can turn this scenario into an opportunity. By divesting from these underperforming investments, you can offset the money you owe in capital gains taxes. For instance, if you gained $10,000 from one investment but lost $4,000 on another, selling the losing investment nets you a potential savings of $4,000 against your tax obligations. This approach not only allows you to bring down your taxable income, but it also emphasizes the importance of strategic decision-making. By being mindful of your investments and their tax implications, you can foster a healthier financial future while maintaining a balanced investment portfolio. Understanding support and resistance in market dynamics. Support and resistance levels are essential tools in technical analysis that help investors navigate the complexities of financial markets. A support level signifies a price point at which a stock tends to attract buying interest, often due to perceived value by investors. This becomes a safety net during price drops, acting as a psychological barrier that many traders are unwilling to breach. On the other hand, resistance represents a price threshold that a stock struggles to surpass, often reflecting a point where selling pressure outweighs buying enthusiasm. By identifying these pivotal levels, investors can develop more informed strategies for their trades. Support levels can serve as potential entry points, while resistance levels may indicate optimal exit points. Additionally, understanding that these levels can change over time reinforces the dynamic nature of the market, providing opportunities for growth and learning. Ultimately, leveraging support and resistance empowers traders to make more strategic decisions, fostering a greater sense of confidence in their investment journeys. Conclusion. In our exploration of essential stock market terminology, we've illuminated key concepts that are pivotal for both novice and seasoned investors. From the fluctuating rhythms of bull and bear markets to the strategic advantages of dollar cost averaging and tax-efficient investing, each term builds a robust foundation for understanding the complexities of finance. Empowering yourself with knowledge not only equips you to make informed decisions, but also inspires confidence as you navigate your financial landscape. As we cultivate this understanding, we pave the way towards creating opportunities for a prosperous financial future. We truly value your input and invite you to share your thoughts and personal experiences in the comments below. How has your understanding of these financial terms shifted over time? If you found this video beneficial, please subscribe for more enlightening content, and don't forget to explore our curated budgeting resources through the links provided. To enhance your financial management skills, consider the comprehensive budgeting tool available with the Better Budgeting app below. Let's take on this enriching journey together, ensuring that financial literacy becomes an empowering asset in your life. We look forward to seeing you in our next video. Happy investing!
Welcome to the True Money Makers channel. We're glad you're here to check out our daily selections. Be sure to subscribe so you don't miss any of our crucial financial success tips. And we wish you all the best.